As we look ahead to 2024, our next guest says that investors should not keep their strategy on autopilot and tend to be prepared to make portfolio adjustments. With much debate around Fed policy going into the new year, investors will still have to keep their eyes on economic data to determine moves in the market. The data-dependent Fed going to be looking at information like today's JOLTS report, which showed the labor market slowing, job openings falling to just 8.7 million in October. Joining us now, we've got Keith Lerner, Truist Co-Chief Investment Officer. Keith, always a pleasure to grab some of your insights. Thanks for kicking off the trading session here with us about 35 minutes into today's activity. As you think about that portfolio repositioning that some would be apt to consider going into 2024, what most notably comes to mind for you?
Yeah, well, first, great to be with you, Brad and Sean. Always a real pleasure. So, the calendar shifts. Our strategy doesn't shift because of the calendar. We're really going into 2024 the position the way we are. And what that means is, we're basically more in line with our long-term targets across stocks, bonds, and cash. We've had big overweights in the U.S., big overweights in large caps relative to small caps. And what I think it is one of our key models is to be prepared that as we progress in the year, that our strategy by the end of next year will probably look a lot different than coming in, because there's a lot of key questions that obviously we're all focused on. You just mentioned one of them, the Federal Reserve policy as an example. Historically, after the Fed does its first rate cut, which the market's starting to price in March, which we actually think is a little bit premature, but either way, when you look 12 months forward, the market moves up more than 10% or less than 10%, depending on if you go into a recession. So that, along with the election, there's going to be a lot of tactical opportunities. But again, you also have to be patient for more of the evidence to shift more decidedly one way.
Keith, when it comes to the fact that you're saying that investors need to just be prepared, they cannot be on autopilot when it comes to some of their strategies, some of their investments. How would you compare maybe your anticipation for 2024 to what investors had to do this year and then pre-pandemic levels? I mean, when it comes to that hands-on type of approach that you're advocating for.
Yeah, so, I mean, for some folks that have a 10-year horizon, 1 year is not going to make that much of a difference. But what I'm basically saying is I think, when you look at history in any year, by the way, but especially one where the Fed's shifted, is that you're more likely going to have a more dramatic move than, 5% in either direction. So I would just say this year, relative to the early part of a cycle where you basically just want to be part of the market, I think it's being more important to shift within the market. So that means right now we're overweight large caps, we're still overweight technology and communications. At some point during the year, I think it will make sense to dig harder into small caps. Now, they've done better more recently, but other areas of the market, and there's also a probability if we start seeing some of that job data, which still is firm, starting to weaken, maybe we can become more defensive. But again, instead of pushing our narrative on what the market should do, we'll let the data speak for itself. In some ways, we're data dependent, just like the Fed.
When you talk about the fact that maybe investors should be ready to shift to some of those underperforming parts of the market, I know a lot of it just depends on the data that's coming out, but more specifically, I guess, what are you looking for in terms of maybe the fact or some of the signals that you would be getting that would then signal to you that you need to shift your strategy?
Sure. So there's a couple of things we look at in our strategy. The first thing we start off with is just understanding what valuation. We always say valuation is a condition, not a catalyst. So what is the catalyst? When we look at equity markets and in general, what we want to see is, one, is it oversold or overbought? That's one condition. What are the relative earning trends? So one of the reasons why the U.S. has outperformed other markets is the earnings momentum is much stronger than the rest of the globe. So if that shifts, that would change our view. And then we also listen to the message of the market, relative price trends. So typically when we see 2 out of the 3 of those factors move one way, that leads us to change our position. Right now, going back to large caps have a lot more technology than small caps. So you would need technology to weaken. Right now, technology is rich, the earnings momentum is really strong, and the relative price momentum is still really strong as well. So we're staying overweight there. If we start seeing some cracks in those earning trends, we would shift our position.
Keith, you alluded to a moment ago some of the international inputs that we also have to continue to consider here. S&P Global had actually put out their China PMI reading this morning as well here, signaling expansion, and the overall pace of expansion remains very subdued. Business expectations in particular continue to run far below long-term averages, prompting firms to trim their headcounts for a third successive month in November. How does this all translate into some of the most exposed, perhaps U.S. traded companies that are in a lot of people's portfolios out there?
Yeah, well, I do think it does put some risk to some of those earnings that have high exposure to China. But I would also say, if you even take a kind of zoom back a little bit, one of our biggest, most convicted calls of the last year has been to, excuse me, be underweight emerging markets. In fact, in our core portfolios, we've had zero exposure. And part of that is China is about 30% of the emerging market index. And what's also interesting, if we all talk about the tech names here doing really well, China tech names are almost close to relative lows. So I would say one of the main things up front is still be overweight the U.S. And then within the U.S., more specific to your question, is understand where their exposure is, and are they making steps to move some of that business to other areas outside of China. We're seeing foreign direct investment really come out of China for the first time in about 20 years. We expect that likely continues.
Keith, just to give this conversation a little bit of a circular ending here, at the start of the conversation you mentioned, just because the calendar year changes doesn't mean our strategy entirely changes here. But at the end of the day, I've been thinking through and compiling some chief investment officer New Year's resolutions from folks like yourself across the industry here. If there's one kind of resounding thought that you take into the next year, what would it be?
I would say the most important thing is to stay agile. Everyone has these outlooks that they put out about where the market's going to be 12 months from now. I mean, if I asked you, Brad, where the market's going to be on September 13th, you'd say, I have no idea. More importantly is have a basis for your view and adjust as the data shifts over time. That's what we've done over time. We've been successful at doing so, in general. And I think just stay agile and follow the way of the evidence.
All right, Keith Lerner, always great to get your perspective, your insight, and the New Year's resolution. And always great to talk to you, Truist Co-Chief Investment Officer. Thanks, Keith.
Thank you.